Someone you know just got back from 2 weeks in Italy. Business class both ways. They stayed in a hotel that charges more per night than most people spend on groceries in a month. They posted from a boat. They looked expensive. They looked relaxed. They looked like someone who has money and is spending it without thinking very hard about it. Their taxable income last year was $31,000. That is not a typo. That is not a crime. That is a system. And understanding how it works is what this entire video is about. Here's the first thing you need to understand, and it is the thing most people never separate cleanly. There are three different numbers that describe a person's financial life: taxable income, net worth growth, and cash flow. Most people collapse these into one idea. Rich people do not. Rich people optimize aggressively for the first number, minimize it wherever the law permits, and let the other two run. The IRS taxes taxable income. It does not tax your net worth growing. It does not tax the loan you took out against your portfolio. It does not tax unrealized gains sitting inside an account. It taxes what you realize, what you recognize, what you pull through the gate. The game, for people who understand it, is to fund a full life without pulling very much through that gate. The mechanism has three moves. They are not secret. They are written into the tax code. Financial planners, estate attorneys, and private bankers have been using them for decades. They have a name: buy, borrow, die. Move one is buy. You accumulate appreciating assets instead of maximizing salary. Stocks, index funds, real estate, ownership in a business you helped build. These assets grow. That growth is not taxable while it sits unrealized. A share of stock that doubles in value does not send the IRS a check. A piece of real estate that appreciates 40% over 7 years does not generate a tax bill until you sell it. You hold. You let the assets compound. The accumulation phase is largely invisible to the tax code. This is not a loophole. It is the design behavior of a system that distinguishes between a gain you have locked in and a gain you have realized. Move two is borrow. Here's where people get confused, and the confusion is worth correcting carefully. When you need cash, instead of selling an asset and realizing a taxable gain, you borrow against it. You go to a bank, a brokerage, a private lender. You pledge the portfolio, the property, the business interest as collateral. The lender gives you a line of credit or a structured loan. You spend that money, you travel in business class, you cover the hotel, you fund the next investment. The IRS does not classify loan proceeds as income. You did not earn it, you borrowed it, you have an obligation to repay it. The lender is not underwriting your salary or your character. They are underwriting the asset. The asset is worth more than the loan. That is the underwriting. That is the entire transaction. The interest on the loan, depending on how it is structured and what the proceeds fund, may be deductible. The capital gains you did not trigger by not selling remain deferred. The asset continues to appreciate while the loan sits against it. Move three is die. This one is the part that feels uncomfortable to say plainly, so let's say it plainly. Under current U.S. tax law, when you die holding appreciated assets, the cost basis on those assets resets to the fair market value at the date of death. This is called the stepped up basis. If you bought stock at $10 and it is worth $400 when you die, your heirs inherit it at $400. The $390 of gain that accumulated over your lifetime is never taxed as income. It disappears from the tax ledger. Your heirs can sell at $400 and owe nothing on the prior appreciation. The loans taken in move two can be repaid from the estate. The assets that served as collateral transfer with the reset basis. Done correctly, across a long enough timeline, an enormous amount of wealth transfers between generations with very little of it passing through income tax. That is the spine. Buy, borrow, die. Three moves. One cohesive strategy. Legal under current federal tax law. Now let's be exact about one thing before we go further. Tax avoidance and tax evasion are not the same thing. Avoidance is using the law as it exists to minimize what you owe. Evasion is lying, hiding income, filing false returns. One is a financial strategy. One is a federal crime. Everything in this video lives inside the first category. The people we are describing are not hiding assets in offshore accounts and hoping no one notices. They are using margin loans, securities-backed lines of credit, grants or retained annuity trusts, dynasty trusts, and stepped-up basis provisions that Congress wrote, debated, and left in the code. What we are going to do is climb the ladder. Every rung has a different mechanism, a different minimum, and a different level of access. We start at the margin account. We end at the dynasty trust. Let's go. The first rung is almost invisible. You are 24 years old. You have a brokerage account. You put money in every month. You buy a broad index fund, something that holds hundreds or thousands of companies inside a single ticker. The market goes up. Your balance increases. You do not sell. That is it. That is the entry point for the entire strategy. You are already doing it. Here is the mechanism underneath it. Every dollar of growth sitting inside that account is an unrealized gain. It does not exist on a tax return until you sell. The IRS has no claim on a number that has not been locked in. A portfolio worth $12,000 that you funded with $9,000 in contributions has $3,000 in embedded gain. That gain belongs to the future version of a transaction that has not happened yet. While it waits, it compounds. The tax compounds too, in the sense that you owe it eventually, but only on the nominal gain at the moment of sale. The years of compounding that happen before the sale are yours. Simply not selling is a tax deferral strategy. It is not glamorous. It does not require an attorney. It requires patience and the discipline not to react when the market drops 14% in 3 weeks and everyone around you treats that as a signal to do something. This is level 1. Buy, hold. Do not sell unless necessary. The tax bill is deferred as long as the position is intact. Most people never think of this as a strategy. It is a strategy. The second rung introduces debt. At some point, the portfolio grows large enough that it becomes collateral. Most major brokerages offer this immediately. It is called a margin loan. You pledge your brokerage holdings, the brokerage lends against them, typically 50 to 70% of the portfolio's value depending on what you hold and how concentrated it is. You pay interest on the borrowed amount. You do not sell anything. No taxable event. The cash arrives in your account. You spend it or deploy it. The interest rates on margin loans run higher than you might expect. Brokerages charge variable rates tied to benchmark rates, and when the rate environment shifts, the cost of carrying that loan shifts with it. The other constraint is harder, a margin call. If the portfolio falls in value and the collateral ratio drops below the required level, the brokerage can demand immediate repayment or liquidate positions without your consent. That liquidation is a taxable event, triggered not by your choice but by market movement at the worst possible moment. Margin loans are the simplest version of the borrow mechanic. They are also the most fragile version. The strategy works cleanly when the market cooperates. When it does not, it can unwind faster than you can respond. This is not a reason to avoid the concept. It is a reason to understand the specific product before you use it and to use it conservatively. The third rung is where the mechanic stabilizes. Somewhere around $1 million in investable assets, a different product becomes available. It is called a securities-backed line of credit, or an SBLOC. Some institutions call it a portfolio loan or a pledged asset line. The names vary. The structure is similar. You pledge a diversified portfolio as collateral. The lender, usually a private bank or the wealth management arm of a major institution, extends a revolving line of credit against it. The terms are meaningfully different from margin. Interest rates are typically lower. The collateral requirements are less reactive. You are not subject to the same hair trigger liquidation risk that a standard margin account carries. The lender's underwriting focuses on the stability and diversification of the portfolio rather than just a daily mark-to-market number. You draw from the line when you need cash. You repay at whatever pace the agreement permits. The portfolio stays invested. The gains stay unrealized. The line of credit is not income. Private banks like these instruments for a specific reason. The loan stays on their books. The portfolio stays under their custody. You are now a client with assets and a borrowing relationship and an ongoing need for advice. That is a profitable client profile for a private bank, and it is why access to these products tends to improve the larger and more diversified the portfolio becomes. If you have watched the private banking video on this channel, this is the product category that sits at the entry point of that world. Here's how people actually use borrowed cash at this tier. A down payment on a home, funded by a draw on the SBLOC rather than a sale of appreciated stock. Living expenses during a year of low income, keeping the taxable income number small while the portfolio continues compounding. A bridge between one investment and another, covering a gap without forcing a liquidation at an inopportune time. The portfolio stays intact. The market keeps working. The borrowed cash funds the life. Now the risks. Stated plainly, rising interest rates make the cost of carrying the loan real and material. Concentration in a small number of positions makes the collateral volatile and the lender nervous. A portfolio built on 3 tech stocks is not the same collateral as a portfolio built on 3,000 companies. Discipline matters in a way that does not show up in the promotional materials. The non-glamorous rule is this. This strategy works for people with stable, diversified assets and the temperament not to overborrow. It does not work for people who treat the credit line as a bonus income stream and ignore the collateral maintenance requirements. And here is the tax mechanics piece. stated without decoration. At this tier, from 0 to roughly $10 million in portfolio value, what you're doing is deferral, not elimination. The gains are still there, embedded in the positions. The day you sell, you owe. Long-term capital gains rates are lower than ordinary income rates, which is real and meaningful, but the bill exists. The only path to permanent elimination, not deferral, but actual elimination, is a third move, the one that requires dying with the assets intact and passing them to heirs with a stepped-up basis. At this tier, most people are not yet thinking about that move. They are building the asset base that makes it possible. You build it with time and contributions and the discipline not to sell. That is the entire first tier. It runs from a brokerage account with an index fund to $1 million pledged asset line at a private bank. The mechanics scale. The principle stays the same. You buy, you hold. When you need cash, you borrow against what you built instead of dismantling it. The next level is where the asset classes change and the transactions get significantly more complex. At $10 million, the architecture changes. Not because the principle changes, buy, borrow, die. That spine holds at every level. What changes is the asset class that anchors the collateral, the institutions willing to lend against it, and the structural layer that begins to appear around everything. Like scaffolding, nobody talks about in public. The asset class that enters the picture is real estate, not a primary residence. Investment real estate, a small apartment building, a commercial property, a portfolio of rental units in a market with durable demand. The reason real estate occupies a specific place in this strategy is not appreciation, though appreciation matters. The reason is depreciation. Here is the mechanism. The IRS allows owners of income-producing real estate to deduct the cost of the building, not the land, over a fixed schedule. Residential property depreciates over 27.5 years, commercial over 39. What this means in practice is that a property generating positive cash flow on paper can show a tax loss on a return. The building earns rent. The depreciation deduction offsets the income. In some cases, it offsets income from other sources. The asset appreciates in the real world, while the tax treatment says it is wearing out. That gap between economic reality and accounting treatment is the advantage. No other major asset class produces it at the same scale with the same regularity. You hold a property worth $4 million, it generates income, it appreciates. The depreciation clock runs. The tax liability does not arrive. You have never sold. Now borrow against it. A cash-out refinance on investment property works simply in structure. The property has increased in value. The existing mortgage balance is lower than the current value. A lender issues a new mortgage for a larger amount, pays off the original, and sends you the difference in cash. That cash is not income. It is debt proceeds. The IRS does not tax borrowed money. You just extracted liquidity from an appreciating asset without selling it, without triggering depreciation, recapture, without a capital gains event. The property remains on the books. The depreciation clock keeps running on the full value. The cash sits in your account. A HELOC on investment property follows the same logic at a smaller scale. A revolving line against the equity in a property rather than a full refinance. Useful for bridging periods, for funding the next acquisition, for managing the gap between a large expense and the next rent cycle. The mechanics are different from a residential HELOC. The rates are higher. The underwriting is stricter, but the tax treatment of the proceeds is identical. Borrowed money is not income. This is where the strategy starts to stack. At $10 million, you are likely managing several properties alongside a public market portfolio and possibly a business interest. Each asset class produces a different type of income and a different type of deductible expense. The real estate offsets some of the income from the portfolio. The portfolio serves as collateral for liquidity when the real estate cycle is slow. Cross-collateralization is the term lenders use when they take security interest in multiple assets across a single borrower relationship. It is also the description of what a sophisticated borrower builds intentionally. Multiple assets, multiple lenders, multiple credit facilities that do not all depend on the same collateral performing at the same moment. Managing that architecture requires something a brokerage account alone does not. It requires a relationship. At $100 million, the conversation shifts to private banking in a way that makes the earlier tier look like retail. Not because the products are unrecognizable, because the underwriting is entirely bespoke. A private bank at this tier is not matching you to a product that already exists. They are building a lending structure around your specific balance sheet. The collateral is a combination of real estate equity, investment portfolio value, business interest, and in some cases, the expected cash flows from trusts or other vehicles. The credit line has no fixed ceiling in the sense that a standard product has. The bank models your net worth, your liquidity profile, your expected estate trajectory, and they price a relationship, not a loan. This is exactly the territory covered in the private banking video on this channel. The client relationship at this tier is not transactional, it is generational. And the generational piece is where estate planning enters the architecture. A GRAT is a grantor retained annuity trust. The structure works like this. You transfer an appreciating asset into the trust. The trust pays you back a fixed annuity over a term, typically 2 to 10 years. If the asset grows faster than the IRS hurdle rate, the excess appreciation passes to heirs at the end of the term, outside your taxable estate. No gift tax on that excess. The appreciation above the hurdle is simply gone from your estate, transferred without a transfer tax event. The asset did exactly what you expected it to do. The trust captured the upside. The heirs receive it. You absorbed a statutory annuity in return. GRATs work best with assets that are expected to appreciate significantly over the term. Closely held business interests, pre-IPO positions, a real estate portfolio entering a high growth cycle. The mechanic is not guaranteed and does require the asset to outperform the hurdle rate to produce a benefit. If it does not, the trust ends and the assets return to you. You are not worse off. You simply run the play again. Around all of this, a structural layer appears. LLCs holding the real estate, an umbrella liability policy across the portfolio. Trust wrappers that separate beneficial ownership from control. These are not tax strategies in isolation. They are continuity strategies. They ensure that an adverse judgment, a failed business, a lawsuit from a tenant does not unravel the architecture that took decades to build. At this tier, the goal has changed. It is no longer about saving taxes in isolation. It is about control and continuity, and making sure that when the third move arrives, the assets are positioned exactly where they need to be. At $100 million, the third move stops being theoretical. Die. That word has always been in the strategy. At the early levels, it sits quietly at the end of the sentence. Abstract, distant, something to address later. At this tier, later has a legal team, a trust document, and a 40-year timeline attached to it. The planning is not morbid. It is precise. And the precision is the point. The asset base at this level typically includes operating companies, concentrated equity positions that have never been sold, real estate portfolios with embedded depreciation, recapture, and private credit structures that have been running for years. Every one of those assets carries unrealized gains. A stake in a company built from nothing and held for 25 years might show a cost basis near zero and a current value somewhere north of $60 million. That gap, $60 million of appreciation that has never been taxed, is not a problem waiting to be solved. It is the engine. The strategy has kept it unrealized deliberately, borrowed against it, spent the borrowed proceeds, and held. The question at this level is not how to access the gains without triggering tax. That question was answered at the lower tiers with securities-backed lending and cash-out refinances and portfolio credit lines. The question here is what happens to those gains when you die? And the answer, under current law, is that they can disappear. The stepped-up basis rule works like this. When you die holding an appreciated asset, your heirs inherit it at its fair market value on the date of death, not your original cost, not the price you paid 30 years ago, the value on the day they receive it. If the position was worth $60 million at death and the original cost was $400,000, that $59,600,000 gain is gone from the tax ledger permanently. The heir can sell the asset the next morning and owe capital gains tax on exactly $0 of appreciation because their basis was stepped up to the full $60 million at the moment of transfer. This is the end game that the entire strategy has been building toward. Decades of accumulation, decades of borrowing against the value, controlled spending through debt proceeds rather than asset sales, a tax liability that grew larger every year in economic terms and arrived at zero on the day it was supposed to be the largest it had ever been. Now apply trust architecture around that mechanic at scale. A dynasty trust is an irrevocable trust designed to hold assets across multiple generations, not just your children, your grandchildren, their children. In states with favorable trust law, Nevada, South Dakota, Delaware, the trust can run for centuries with the right drafting. The assets inside the trust are removed from the taxable estates of each generation that benefits from them. The trust itself is not a taxpayer in the same way an individual is. It holds, it compounds, it distributes according to terms you set when you funded it. And because the assets never formally pass through an heir's estate in the traditional sense, the estate tax exposure at each generational transfer is substantially reduced, or in some structures eliminated entirely. The combination of the dynasty trust with the stepped-up basis mechanic is where the strategy reaches its final form. You transfer assets into the trust structure during life using gift tax exemptions, GRATs to push appreciation out of the estate, and careful valuation discounts on illiquid interests to minimize transfer tax at the point of funding. The trust holds the assets. The assets compound. Borrowing against trust assets continues to fund lifestyle and operations without triggering realized gains inside the trust. And when the assets eventually transfer across generations, the basis rules, as they stand today, can reset the embedded gains at each qualifying step. Decades of unrealized appreciation, permanently untaxed, not evaded, extinguished by statute. Here is where the reality check has to arrive, because this script has no interest in selling you a fantasy. The federal estate tax exemption is not permanent. It is a legislative number set by Congress that has changed repeatedly and is scheduled to step down significantly when current provisions expire. The step up in basis rule itself has been a target of reform proposals in multiple administrations. Several states impose their own estate taxes with lower exemption thresholds. The trust structures that work today depend on laws that were not the same 20 years ago and may not be the same 20 years from now. Every advisor building this architecture for a client worth $500 million is simultaneously stress testing the plan against a scenario where the step up is eliminated, where the estate exemption is cut, where a state changes its dynasty trust statutes. The strategy is not a guarantee. It is a position taken inside a set of rules that are controlled by people who did not design them with permanence in mind. None of this is evasion. Every mechanism in this video, securities-backed lending, depreciation, GRATs, dynasty trusts, the stepped-up basis, exists in the Internal Revenue Code or in Treasury regulations or in state trust statutes written by elected and appointed officials. The people using these strategies are not breaking rules. They are using them with a precision that most people never have the assets, the advisors, or the time horizon to apply. Whether those rules should exist the way they do is a legitimate policy question. That question belongs to voters and legislators. This video is not the place to resolve it, it is the place to understand it. The latter, start to finish, looks like this. Build or buy an asset that appreciates. Borrow against it to live, never sell. And if the law holds, die with it and hand the basis to the next generation clean. If you want to understand how the trust structures at this level actually work from the inside, the Trust Fund Kit video on this channel walks through the beneficiary experience in detail. The asset protection and private banking episodes cover the institutional side of the borrowing layer. And if you want the next breakdown in the every level of series, subscribe and it will find you. The strategy was never secret, it was just expensive to learn.